When we think about the fall of Rome, we immediately imagine the barbarians, warriors breaking through the walls, fleeing soldiers, poisoned emperors. But an empire doesn't fall only from the outside. The real collapse always starts from within, and what quietly destroyed Rome from the inside was money. Rome didn't fall just because of wars. It fell because people lost trust in its money. And this story still continues today. Only the silver coins have been replaced by paper money and digital numbers. It all started with a coin. For centuries, Rome's economy was built on one coin, the denarius. It was made of pure silver, solid, reliable and trusted. Soldiers were paid with it. Merchants accepted only it. In short, denarius equals trust. As long as people trusted Rome, they trusted its money. But as the empire grew, so did its debts. Armies, roads, wars, taxes, one by one drained the treasury. Raising taxes risked rebellion. So emperors found another way. They reduced the silver in the coin. It looked the same, but inside it held far less value. In other words, Rome started cheating with its money. Value fell, trust vanished, the system collapsed. At first, no one noticed, but over time, the silver content of the denarius dropped from 95% to less than 5%. People could literally feel the difference. The coins felt lighter, and that's when the chain reaction began. Prices exploded, soldiers demanded higher pay, merchants refused to accept the coins. In some regions, people went back to bartering goods directly. When money lost its value, trade stopped and the economy broke down, and worst of all, trust disappeared. Desperate struggles. Emperor Diocletian tried to fix prices by law. He said, "A loaf of bread will cost this much." But when money is worthless, what good is a price tag? The result? The black market exploded. Everyone worked around the system. Eventually, Rome gave up. They minted a new gold coin, the solidus. It helped a little, but it was too late. The empire was already crumbling from within. Rome wasn't killed by the barbarians. It was killed by worthless money. What's different today? Honestly, not much. We just say dollar, euro, or lira instead of denarius. Just like Rome diluted its coins, modern governments keep printing money and pretending it's fine. In 1971, the US dollar was taken off the gold standard. From then on, it was backed only by trust. But trust isn't as solid as metal. Since then, more money has been printed, debts have grown, and inflation has become part of everyday life. The money looks the same, but the value is gone. The truth hasn't changed. When you play with money, the people pay governments present inflation as growth. We see rising wages and call it prosperity. But in reality, the money in our pockets is disappearing. The Romans lived through it. Germany in the 1920s lived through it. A loaf of bread went from 1 mark to 200 billion marks. Zimbabwe in the 2000s lived through it. Prices doubled every single day. They all shared the same story. The state tried to cover its debts with lies, and the people always paid the price. 3 lessons from Rome to today. Inflation is not an accident, it's deliberate. Real wealth isn't measured in money, but in production, skill, and tangible assets. No system lasts forever. Romans never believed their money would one day be worthless. History keeps repeating itself. When money loses trust, society falls apart, and collapse always begins from within, from the treasury. Final word. They say history doesn't repeat. But if you don't learn from it, it repeats you. Rome's story isn't just the past. It's a mirror of today. So, remember this after reading. When money loses its value, everything ends.